Well, there certainly is a lot happening in the world today, but let's hone in on four key items. The first being the bond market and bond yields. After peaking in around springtime of this year, what we've seen is curves flatten and longer yields come down over the last several months. There are a multitude of factors, but the two main ones in our view are just we're getting closer and closer to the commencement of the Fed taper. From comments at Jackson Hole, it might commence at the end of 2021 and gradually phase out through 2022. But also, we believe there's a revaluation of what the global growth picture is going to look like economically once we emerge from the recovery. So you're going to see a V-shaped recovery, and then you're going to go into this new normal pace of econ growth globally. And given the higher debt levels that countries are coming out of the pandemic with, it does sort of portend the potential for a more moderate pace of growth, and that's what's being reflected in the yield curve as well. Second is econ data is becoming a little bit more mixed, and that's to be expected. When we first came out of the gates and reopened economies, we knew the data was going to be phenomenally strong because of that sharp resumption of activity and also because of really easy comparables from 2020. But we knew that once we got to a majority of the economy being open, you're going to see a bit more noise, especially now that we're seeing a bit of a resurgence of new cases due to the Delta variant. Inflation. Inflation remains elevated, but it has appeared to plateau and is starting to pull back a little bit. More importantly, some of the factors that we had highlighted as being potentially transitory, like used car prices, has clearly abated. Last but not least is the virus. It's the battle of the V's, vaccination versus variants. Vaccinations are progressing very well, although still very concentrated in a few countries. And what we're watching for is really to see it spread out to the rest of the world. And then on the other hand, really the emergence of new variants. It is all about the Delta variant at the present time, but there are one or two new variants that are closely under watch as well as being potentially variants of concern. In terms of what we're watching for next, it's still a lot of policy watch. So first would be the central banks, Fed taper, possibly followed by ECB taper sometime in 2022. We're watching the Bank of Canada very closely, as well as the Bank of Japan and also the PBOC. Now, even though the People's Bank of China doesn't directly impact the Canadian economy, as the second largest economy, what they do can impact especially the Asia region and global growth as well. On the fiscal front, we're also watching to see for signs of additional stimulus. So in the US, it's watching the progression of that infrastructure bill that the Biden administration is talking about. In China, economic data has been quite weak for several months now. So the PBOC and the Chinese government has talked about providing a little bit more stimulus, just small and quite targeted, but that's something we're going to be watching closely. On the earnings front, we're going to be watching for margin pressure. So inflation was an issue that was discussed by almost every single company this past earnings season, but only a few of them actually had a significant negative impact on their margin. So a lot of them were either able to pass them through or they had sufficient inputs in their inventory. They could actually use some of that lower cost inventory first. But next quarter, we're going to have been living with high inflation for a while now, so it'll be interesting to see what happens on the margin front. And that's quite important because equities have done very well, so any potential signs of margin erosion could be detrimental to performance. And last but not least, it's the virus. We're going to be talking about it, unfortunately, for a while. More importantly, we're going to be focused on the vaccination rate, really seeing how much the vaccination rate is able to ramp up in the rest of the world, especially the emerging countries. And that's an important factor to try to contain and manage the potential emergence of even more new variants. In the portfolio, we've reduced our overweight position in equities, reflecting valuations, the upcoming commencement of the Fed taper of their bond purchase program, and new virus variants having the impact of really prolonging the economic recovery to perhaps more of a kind of a wavy one upwards as opposed to a continuation of the V-shaped recovery. In equities, geographically, we still like the US, despite valuations. There's still a strong impulse there fiscally with a multi year infrastructure spending plan in the works. The US is also home to many multinational companies, especially in technology, that are going to continue to benefit as the rest of the world gradually recovers. Our main overweight position, though, in equities is in global mid caps. These companies being more pure plays in the specific countries that they're domiciled in, we believe will really benefit the most as we see this global recovery start to roll out to the rest of the world. In fixed income, we are underweight, we remain underweight, as well as being underweight duration. We do have a preference for credit, and we also like opportunistic fixed income like real return bonds or emerging market bonds where there's an attractive carry that you can clip. Overall, though, we think that a significant part of the recovery has been priced in, especially in equities. So at this point, it is important to be focused on quality, making sure that you're investing in the quality companies with good balance sheets and experienced management teams. So with that view in mind, we've been allocating even more to our active managers so that they can then make those investment decisions. I would say, in summary, we've come a long way from March of last year. There's a lot more that's known about the virus. The development of vaccines have really progressed very quickly, and the rollout of vaccinations has been quite phenomenal. Although now we would love to see it spread out to more countries. We are going to have to learn to live with COVID, and so what it means is that global economic activity might just have these periods of ebbing and flowing over the next year or two. But fundamentally, we believe there is a strong footing. It's just ensuring that when it comes to the portfolio, that we're being very disciplined in reallocating away from positions that have become overextended into opportunities where there might be more attractive risk reward.